Let's talk more about the markets with Amy Wu Silverman, head of derivatives strategy at RBC Capital Markets. Just talking about you earlier. Amy, welcome. It's good to see you. And before I even looked at the notes, I was looking forward to hearing how things are set up for this number. And you said the implied volatility is about average ahead of it. I thought it might be more important, but you're not seeing that.
Yeah, it's interesting because the S&P yesterday was applying about 1.75%, Joe, as just the move for today, which if you kind of look to other CPIs is fairly average. And then the other thing is usually that demand for call buying, which we've seen over and over and over, this focus on up crash has been really important in other CPIs. And it's still important, don't get me wrong. It's just a little bit more muted this time. You know, I read that as folks have gotten more into the market now than they have kind of the last couple times we've had CPI and they've been forced to participate when things turn out better than expected.
You also point out that the losers have become the winners. Foul is now fair, I guess, but it's already happened to some extent. So now people actually do have something to hedge, which we didn't see right at the beginning of the year.
Yeah, so investors I have talked to have relatively unkind names for this rally. They've called it the crap rally, the trash rally. So, whatever you want to name it, it's the stocks that have really cleared the most this year, your Carvanas, your Pelotons, your AMCs. Not only were they the losers of 2022, these are free cash flow negative names. These are names that are highly levered. And so, there's sort of two camps right now. There's folks who think that what else is there that you would consider low quality? This will probably rally more. So I actually have investors asking me for names that are low quality but haven't rallied as much as a Carvana. And then I have a second camp, which is kind of in disbelief that this is where we're sitting, even with the Fed still kind of on the path of continuing to hike. And so I think things like CPI today become so crucially important because, unfortunately, we're still quite data dependent. And that's where you see the surge of zero data expiry trading happening.
Amy, when you say, so there's been a lot of action in calls, you mean people are and you call that hedging. I was not sure whether you were saying they're selling calls against some of their gainers that they've had already, or are they actually buying calls in case it's a cool number today for the CPI?
Yeah, let me clarify it a little. So this is why I call it a tale of two tenors, because it is kind of a muddled picture. So short term, Joe, people are buying calls still. That's the focus because people are still demanding this need to participate if there's sort of this up crash, this rally in the market. But interestingly, kind of 6 months out, 4 to 6 months out, that's where we see traditional hedging. And by traditional hedging, I mean buying puts or buying put spreads or, buying VIX calls, which essentially is expressing downside on the market. Mm-hmm. But that's happening in later tenors, and that is actually happening in exact tenors where the market is starting to price that the Fed will have to cut. So essentially what it's telling me is there's kind of a debate going on in options with some people saying that, we think maybe it is higher for longer, or maybe we think that, the cuts that are priced right now don't make sense kind of a couple months down the road. So
there are still some people that think we see Fed cuts in 2023. That would be the market, you would think, would embrace that, but it would also mean if the Fed's cutting, the economy has definitely slowed significantly. So and that might not be great.